Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Monday, the 3rd of February. I'm Daniel Lam, your host for the podcast. Today is the first trading session for Hong Kong, China, after a break in the Chinese New Year holidays. Now, during this period of holidays, I scored a memorable hat trick of tournament victories. And I hope that after a lackluster year of the rabbit and an even worse year of the dragon, that I can make wrong things right in my chess performance in the year of the snake. However, sentiment is not as bullish for global risky assets at this moment. Following the volatility caused by DeepSeek, we now have Trump's news to implement 25% of tariffs on goods from Canada and Mexico, and an extra 10% on goods from China. So this is a reality check, as there was the narrative that perhaps there would be some negotiation between the US and China. Well, there would still be, but tariff has become a reality now. So what are we likely to see in risky assets? Well, already we're seeing Asian equities in the red. The US listed Hong Kong China equities were very strong over the last few sessions, with a number of stocks benefiting from the news flow on DeepSeek and the rise of Chinese AI. But they are giving up all these gains. We see 20,300 as a near-term resistance for the Hang Seng Index, with 19,600 as a near-term support. Now, if news on the trade war worsens, we may see Hang Seng Index testing the support at 18,670. The moves show the importance of having a barbell approach in Hong Kong China equities, with exposure to the Hang Seng Technology Index, as well as the high dividend yielding non-financial state-owned enterprises. How about US equities? Well, that's still on an uptrend, but again, it has been hitting resistances around the 6,120 level, which is challenged again on Friday. While many have been putting their investment faith in US exceptionalism, confidence has already been shaken by DeepSeek. And now some investors will be questioning how Trump will try to generate non-inflationary growth, given tariffs are inflationary in nature. So this may open the path for a mild correction in the S&P 500 index to the 5,800 level. Stronger support is at 5,650. Now, in terms of bonds, US 10-year government bond yield is testing the 4.5% support level. It is displaying a head and shoulders pattern, thus potentially opening its way to the 4.25% yield level, as investors seek safe haven for their investments for the near term. Lastly, gold is likely to be continuing to do well, with seasonal demand from India to China, as well as central banks' effort to diversify. That is all from me for today. As always, if you enjoyed this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.